On Wednesday, Google reported the best cloud quarter in its history. Revenue went up 82%. Operating margin went up from 21% to nearly 36%. The stock fell 5%. Because buried in the same report was a number Google hasn't printed in years. Free cash flow of negative $5.9 billion. A year ago, that figure was positive $10.4 billion. Google isn't struggling. Google is spending. That's the story of this week across the entire industry. Enormous demand, enormous spending, and a growing gap between the two. Three things happened in the last 7 days that only make sense together. OpenAI raised its infrastructure plan to $750 billion. The bond market that was quietly financing a slice of this build-out hit its ceiling. And China moved to lock in a parallel AI supply chain outside the American one. Each of those is a headline. Together, they're one question. The AI build-out is now a capital problem, not a technology problem. So who can actually afford to finish it? Start with the demand, because it's real and it's measurable. Google's cloud backlog, that's contracted revenue it hasn't recognized yet, reached $514 billion, growing $50 billion in a single quarter. That's not a projection, that's signed enterprise commitments sitting on the books. So Google did the rational thing. It raised full-year capital spending guidance to $195 to $205 billion, up from $180 to $190. Second quarter spending alone was $44.9 billion, up 107% year over year. The CFO described the business as supply-constrained and signaled 2027 would go meaningfully higher still. OpenAI is running the same play, harder. It raised its infrastructure commitment to $750 billion through 2030, roughly 25% above where it stood earlier this year. And on the same day it named the first campus it will build itself, Project Camellia in Effingham County, Georgia. 1,400 acres, 3.2 gigawatts contracted from Georgia Power under a 25-year agreement. At least $20 billion, likely over 30 by full build-out. Power arrives in phases between 2028 and 2032. Read that timeline again. The electricity for this facility does not fully arrive until 2032. That's the actual constraint now. Not chips, not models. Power and permitting. The consensus case is simple, and it's not stupid. Demand is contracted, supply is short, and whoever owns the compute owns the pricing power for the next decade. Here's the part that got the stock sold. Google's cloud margin expanded to 35.6%. The business is genuinely more profitable, and free cash flow still went negative by $5.9 billion. The profitable part of the business can no longer fund the build-out on its own. That means the gap gets filled somewhere else. Debt, cash reserves, or slower spending. Google broke a 20-year funding habit to raise capital for this. And notice what OpenAI's number actually is. $750 billion through 2030 is roughly $150 billion a year against a company that does not have anything close to that in revenue. The bet is that revenue arrives before the bill does. So the thesis and the antithesis aren't in conflict about the demand. They're in conflict about the timing. Demand is contracted through 2030. The spending is due now. If the hyperscalers can't fully self-fund, the assumption is that credit markets step in. And for a while, that worked in a place most people never look, the Nordic high-yield bond market. It's small, flexible, and unusually tolerant of risk. In May, a data center operator called Polar DC raised 800 million euros, about $913 million, a record for European data center debt. The logic was clean. Data centers look like infrastructure. Infrastructure has long leases and predictable cash flows. Bond investors like predictable cash flows. Then the next deals came, and the market stopped. Prime data centers and pure data centers both shelved or abandoned their offerings. Bloomberg's reporting describes a market showing indigestion after just a few deals. Investors had worked out three things. First, these bonds are structurally subordinated to other project financing. As one analyst put it, creditors carry risks closer to equity, without the equity upside. Second, the cash burn. A data center consumes capital for years before it earns anything. Investors are underwriting 5 to 7 years of negative cash flow on assets that aren't finished. Third, and this is the one that stopped the deals, investors started asking a blunt question. Does this facility actually have an AI tenant? Or is it riding the AI narrative without the AI revenue? Now be careful with what this does and doesn't prove. A handful of shelved Nordic bond deals is not a credit crisis. It's an early signal from the most permissive corner of the market. But it tells you something specific. The build-out is financeable if you're Google or Microsoft, and increasingly not financeable if you're anyone else. That's not a slowdown, that's a consolidation. Capital scarcity doesn't stop the build-out, it decides who gets to do it. Frame this one carefully because it's a supply chain story, not a politics story. American export controls were designed to do one thing: slow Chinese AI by restricting access to advanced chips. In June, the US extended that logic further, stating the restrictions apply to Chinese firms operating outside China. The theory of the case? Compute is the bottleneck. The US controls the bottleneck, therefore, the US controls the pace. This week, Bloomberg reported that China's AI for all push is defying that containment playbook. Beijing has been enlisting Global South countries into a China-led AI framework, and at its own AI conference in July, Xi Jinping pitched China as the standard setter for global AI governance. The strategy isn't to break the export controls, it's to make them less relevant, by building a parallel stack and a set of countries willing to adopt it. And that's the part that lands on corporate balance sheets. If you're a multinational with operations in both blocks, you're heading toward a world with two AI supply chains. Different chips, different models, different compliance regimes, different data residency rules. Serving both means building and maintaining both. I want to be precise here. Nobody has published a credible number for what dual stack costs or how long it delays enterprise rollouts. When you see a specific figure attached to that claim, treat it as an estimate, not a finding. What we can say is directional and hard to argue with. Two stacks cost more than one, and the companies that can afford two are the same companies that could already afford one. Which is the same conclusion as the last two acts, arriving from a third direction. Put the three together and the picture is consistent. Demand is real and contracted. Google has $514 billion in backlog to prove it. Spending is accelerating past what operations can fund, negative $5.9 billion in free cash flow at the most profitable company in the sector. Outside credit is available to the largest players and closing for everyone else. And the market that all of this is being built for is splitting into two. Every one of those forces points the same way, toward a small number of firms who can carry years of negative cash flow, and a much larger number who can't. Which leaves anyone running a company with a genuine choice, and there isn't a safe answer. Strategy A, build. Commit capital now. Own your compute. Accept years of negative cash flow and the risk that you're buying capacity for demand that arrives late. If you're right, you own the pricing power and you're not renting from a competitor. Strategy B, rent. Stay asset light. Buy compute on the market. Protect your balance sheet and keep the option to change your mind. If you're right, you avoided a decade-long bet on infrastructure that depreciates fast. If you're wrong, you spend the 2030s paying whatever the people who built it decide to charge. Google, Microsoft, and OpenAI have all picked A. They've picked A while the credit market was telling smaller players no, and while the customer base was splitting in two. So here's the question I'd actually like an answer to. If it were